warmly to our valuation course. This is a review of for valuation. Every slide that I have here are from my past lectures. This is also recorded and broadcasted to Uni Tübingen. And this is something that we need as we do this CFA task. The most important part of it is valuation. Let me start by cost of capital. Okay, I got to do something about my doesn't work anymore. Maybe click on it. No, I got to do this by hand. There too, it doesn't work. Nice. Times 1 minus T. T is the tax rate. This is because of a debt tax shield. Debt tax shield means if you are a firm, not an individual, and you borrow money, the interest that you pay on this debt is paid from pre-tax earnings. Therefore, you show less money, less profit to the government after you pay this interest, and you save on taxes. Debt saves you on taxes. If you borrow and the interest is 100,000 euros, you deduct 100,000 euros from your profit, and if your taxes are 50%, you won't pay taxes on this 100,000. You save 50,000. So in this case, government is paying half of this interest. If the interest was 10%, government is paying 5% because you save on your taxes, and your firm saves on the taxes, and your firm is paying 5%. So the 10% cost of debt capital goes down to 5%. To get that in a formula, we multiply that 10% by 1 minus the tax rate of half in my case, in my example, and we get half of 10%, which is 5%. So debt costs us less because government subsidizes it. We have a debt tax shield. Plus, cost of preferred stock, W sub P for preferred, multiplied, K sub P for cost of preferred stock, multiplied WP, weight of preferred stock. So if 20% of our capital is preferred stock, this would be 0.2 plus W sub C, weight of equity, multiplied by cost of the stocks, K sub S. The trick is calculating these costs. These costs sometimes change daily, so we need a consultant to calculate them. And today we go over this most important part of valuation task, which is calculating cost of different components of the capital and sticking it into this formula and estimating WACC. Of course, when you go to the Bloomberg terminals, this WACC is given for our firm. So you could look at WACC for SAP. But you also want to calculate it yourself to show some understanding to CFA. Also, people like you, like professionals, have calculated this. So errors are also likely. You may disagree with. This is somewhat uncommon. The W's refer to the firm's capital structure weights, and the K's refer to the cost of each component. The first step, calculate the cost of debt. Cost of debt is easy, much easier than cost of equity, because cost of debt is the interest that we pay on debt. To the firm, this interest payment on debt is a cost of capital. To you and I, investors, this is earnings. So they pay the cost and they earn it. Usually we use a proxy for this calculation because we want it from the real world. The proxy is usually the 15-year bond of that company that is circulating there in the real world, and the price of these bonds obviously change every second that they trade when the market is open. So that's one reason that the cost of capital changes. We call this yield to maturity. The word maturity means when the debt is paid off. This is a 15-year bond, but we might be somewhere in the middle of its life. And yield means how much money you make. Bonds have a coupon price. This coupon is fixed. That's how much they pay you. Coupon is an old name, comes from the time that we didn't have computers. These things were printed at the bottom of the page of paper, and you as an investor had to get the scissor, coupon, send it to the firm, and they send the interest to you. The coupon, for example, says 10%. The coupon payments are either annual, yearly you get 10%, or there are semi-annual. Twice a year you get 10%. Almost all bonds that I see in the market are for €1,000, $1,000. The reason for that is to make it affordable for average investor, so you have many investors participating. Financial democracy. You and I can lend €1,000 to Siemens, just like that multi-millionaire, if we want to, and we can be a lender to Siemens by buying a Siemens bond. Okay, we look up a 15-year bond. These bonds usually promise to give 1,000, denomination is 1,000, but they become cheaper or more expensive. If they become more expensive, we call them a premium bond. The word is very easy. If they become cheaper than 1,000, we call them discount bond. The reason the price changes is that the interest rate changes in the real world. And part of this reason could also be that the riskiness of the company changes. Imagine that I have a Greek bond at the time of the crisis that they had. They were facing bankruptcy for their national bonds, and it promises to pay you €1,000. And I try to sell it to you for 1,000. You say, well, I don't want it. I'll buy a German government bond for 1,000, and it's less risky. So these Greek bonds, I have to lower the price from 1,000. There is a market that they are bought and sold. And these bonds actually became cheaper during that time, and the price went to half price, 500. So at 500, some greedy individual would buy it, expecting that the crisis may be over and they might get 1,000. And this indeed happened. Greece did not go bankrupt, but sometimes bankruptcies happen. Okay, so this €1,000 bond goes down in price. The opposite can also happen. The country gets less risk, or the interest rates drop. The new bonds are paying less interest. I have a bond that pays more interest. I'll charge you more than 1,000 for it because it's better than the current bonds in the marketplace. So we look at 15-year bond as a proxy. The calculation goes on Excel. It's a typical introductory finance calculation. Here is an example. When 15-year bonds have 12% on semi-annual, face value is always 1,000, you're paying 12% of 1,000. And because it's 6% is half of 12%, every 6 months they pay 6% interest. And this thing is selling today for 1,153.72. In my introductory finance, the exam asks people, is this a premium bond or a discount bond? And they say it's a premium because they look at 1,153 and it's more than 1,000. What is the cost of debt capital, or KD is what we want to estimate. Usually we do this with an Excel. But before we go to the Excel, we look at how much the bond pays, 12%, and it's semi-annual, so pays 6% per year. I have an Excel calculation and sheet on Ilias, but here is a picture of it. It says if you purchase this bond Today, you have to pay 1,153.72 euros. This money is negative cash flow because it goes out of your pocket. You pay it to purchase the bond. So it has a minus in front of it, and it's in the first cell of Excel. And then you go down, and the next cell is 6 months from now. The issuer of this bond gives you 6% interest, not on 1,100, but on 1,000. 6% of the 1,000 is 60 euros. Next 6 months, now we are up to a year, they give us another 60. We write all these 60s for the life of the bond. This is a 15-year bond, so we have to write 30 of them. And at the end, not only they pay us the 60 euro interest, they give us our 1,000 back because this is a 1,000 euro bond at maturity. Then you go to Excel and calculate the internal rate of return, or IRR. Or if your Excel is German, you do EK-FA, which does exactly the same function. And you say, what is an interest rate that makes the price of $1,153.72 fair, given all these cash flows in the future? If we discount them in with what interest rate, we get 1,153. All times that we didn't have computers, we did this by trial and error, but computer spits out the answer, and it says if you put 5% and discount all these, you would get exactly 1,150. That's a fair price. So if you put down 1,153, you yield. Yield is a word that comes from farming. You get a return, you make money, 5% on this investment. But the bond says 10%, 12% interest. Okay, so I'll go 2 slides back because I have this little calculation there. Cost of debt capital in this case is 5%, but because we did it semi-annual, it's 5% 6 months. So we multiply it by 2 and we get 10% per year. Interest in finance on a Bloomberg terminal everywhere is always coded per year. But obviously, if we have the bank's money for 6 months, we pay half that interest as a rent on capital. You multiply it by 2 to make it a year, and you get 10% cost of debt capital per year. So the bond said that we are paying you 12%, but cost of debt capital was 10%. And this changes every day as interest rates change, as the bond price changes. So this is something we have to calculate for SAP. Then we get to the fact that interest is tax deductible. Here we are paying 10%. We got to put their tax rate. We would know their tax rate by looking how much taxes they paid and how much profit they had on their income statement. 40% is a common rate that we use for classroom in US, in Germany. This is approximately what firms pay. But of course, in real world, they go and get it from the income statement. So if they pay 10% interest on their capital, they save 4% of it because of taxation. 1 minus 0.4 is 0.6, and 0.6 times 10% is 6%. Their after tax cost of debt capital is 6%. In fact, in accounting, whenever you see the formula 1 minus tax rate, you can translate it into English or German as after taxes. So this 10% is cost of debt capital before taxes, and 6% is cost of debt capital after taxes. So often they talk about back after taxes. They mean lower the cost of debt capital by 1 minus t, by multiplying it by 1 minus t. Equity does not save us on taxes. The cost of preferred stock. This one is very easy. It takes us back to high school. We calculate this cost from something that is called a perpetuity, a funny name. Perpetuity is something that pays you the same amount every period forever. UK government has a bond that legally is a perpetuity, gives you the same amount every period forever. Of course, we're not going to be around forever, and perhaps UK government is not around forever. But when we want our money, we sell it to someone else, and they get the same interest for every period. The perpetuity formula simply is cost of P preferred equals dividend that P pays. This, in this case, the dividend on the preferred stock divided by price of the preferred stock. So this is a perpetuity formula we remember from high school, or we learn it here, and we use it. A very easy formula in real world gives us the cost of preferred equity. Again, this DP, or the interest that this preferred equity pays, is constant, is the same, doesn't change. But the price of preferred stocks change as they trade every day in the marketplace. They usually are not as volatile as equity or common stock, because common stock allows us to take over a firm. So in this case, they're telling us, here is the problem. What is the cost of preferred stock? Priced at 111.1. This price we get today from our Bloomberg terminal, or from newspapers or some data provider, and we got to get it for SAP too. And we got to see how much dividend they pay. Preferred stocks have their dividends written on at the time of issue. And this is an information that is available on the company's website, or from brokers that trade these preferred stocks. And it stays fixed. It stays fixed. It doesn't change. So it's 10%. Okay, 10% divided by cost of preferred, or price of it that changes every day, gives us 9% cost of preferred equity. Then we go to common equity. It is very difficult to estimate the cost of common equity. In fact, it's directly tied to valuing that common equity, which is what we are doing in this valuation class or competition. Usually the consultants do this 3 different ways. And if these 3 different ways give answers that are reasonably close to each other, 0.1, 0.2 different, they're happy. And that's an estimate. We never get a precise estimate. If I knew what the stocks would do exactly, I would be a multimillionaire and not teaching this class, right? Same with the valuation that you guys doing for SAP. We can't tell exactly what the stock price is going to be and what's the cost of equity capital. But we do this average, we estimate it 3 different ways. And in fact, this CAPM formula won 3 different finance professors the Nobel Prize. It's an easy formula, but it is so useful for a very difficult problem, which is figuring out the cost of equity capital. Okay, CAPM, or Capital Asset Pricing Model. It says KS, or how much Siemens should pay on their stocks. What's a fair cost of capital on Siemens stock? KS equals KRF, the risk-free rate of return. How much the German government, we wave our hand a little and say there is no risk of bankruptcy for German government. How much the German government pays us if we buy their short-term bonds. If we loan our money to German government, the safest asset we have, how much do they pay us? Well, Siemens should pay more than that because they have some risk. German government has no risk. That risk we measure by beta. We talk about betas very soon, but beta is something that you get from the Bloomberg terminal. It measures the riskiness of Siemens as compared to the benchmark, the riskiness of DAX or whole German stock market. Is Siemens as risky as the German stock market? Then beta is 1. Does Siemens have no risk? That will be the risk-free rate. German government, beta is 0. Is Siemens twice as risky as DAX? Beta would be 2. Most stocks have betas less than 2, 1 point something. And you can go and read this from the Bloomberg terminal or from various data providers. Beta is multiplied by a risk premium. The word premium means more. DAX pays more because it's riskier than German. What DAX pays is KM. How much did you make money from DAX? If you invested 100 in DAX last year and you kept it the entire year, and if it became 106, then DAX paid you 6%. That's 6% loss here. So KM is how much money we made from DAX last year, minus how much money we made, how much return we made if we lend our money to German government risk-free. That would give us something extra that DAX paid. That's risk premium on German market, multiplied by riskiness of Siemens. Siemens, if it has a risk of 2, beta of 2, should pay twice of the risk premium that DAX paid. So we multiply that by 2 and add it to the risk-free rate that German government paid. This is one way to figure out what cost of capital and equity of Siemens is. Applies to every company, but they all have different betas, different risks. And if Siemens pays you this cost, then they are, for their capital providers, equity providers, they are doing a reasonable job. If they make more money than this, then we pat the management on the back and they are creating wealth. This cost of capital changes with riskiness of company, and that's reflected in beta. As beta becomes more, cost of capital goes up. An oil company has higher cost of capital than the electric company that sells us electricity, than a utility. Then we go to Gordon's model. We call this DCF, discounted cash flow model, or we name it after Professor Gordon. Either way, it says Siemens should pay a cost that depends on the dividend they pay next period, D1, divided by their price of a stock right now, plus a growth rate. In a minute, I'll teach you how to calculate these growth rates from accounting statements of SAP. So it basically says a stock depends on the fact that the stock will pay you money as dividend every period, and then the company grows and gives you a capital gain, and you put a terminal value on it, and this growth rate comes into estimation. Finally, we go to a method that investment bankers use. You're sitting in a boardroom and you're an investment banker, and they say we want to take over an elevator company. Let's say you're ThyssenKrupp. ThyssenKrupp takes over a lot of small elevator companies. And they say, is this elevator company worth it? How much is it worth it? You say, well, how much was their sales last year? They say 2 million euros. You say it's worth it 2 million euros. What did I just do as an investment banker? I took that 2 million euros sales and multiplied by 1.0. I'm very good at multiplying by 1.0, right? We have a ratio. It's not always 1.0, but it's of that order for sales. It's usually less than 2. We have a ratio that we quickly multiply it by, and we get a price for a company. Here too, we have a risk premium that we know for that kind of business, depending on industry. So we say cost of equity should be the same as cost of debt, but debt is less risky because debt holders are paid first, and equity is a residual claim. They are paid later. Therefore, we have to add a risk premium. Notice that this risk premium is not the same risk premium that went here into CAPM. That was KM minus KRP. This is a risk premium that is different for every industry, and investor bankers know it by experience. Let's use all these three methods and do a classroom exercise, and then you can do a real world exercise with SAP. If the cost of risk-free capital is 7%, the government pays us 7% on their bonds. Obviously, this is high, but in a minute, we'll look at the real world data and see how we can get it. But it's a classroom exercise. If risk premium on the market is 6%, DAX pays 6% more than this 7. DAX paid us 13%. And the firm's beta is 1.2. What is the cost of common equity using CAPM? Typical exam question, a very easy one. The only problem is I have to remember the CAPM formula in my dreams, which I do, right? So we write the CAPM formula. KS equals KRF plus KM minus KRF times beta. And we put numbers into that formula, which we are all very good at, putting numbers in formula. And we get 14.2% cost of equity capital for this company from that CAPM formula. Then we go to DCF, or Gordon's model. This company in our classroom exercise paid a dividend right now, D0 for time 0 right now, this year, and that dividend was $4.19. The price of the stock of this company is $50 right now. Again, we look at both of these inputs available from Bloomberg's or available today. The growth rate is 5%. As I promised, very soon I show you how to calculate the growth rate. What is the cost of common equity using Gordon's approach, or discounted cash flow, or Professor Gordon's method? First thing we got to do is get the dividend for next period. Gordon's formula assumes that everything grows at this growth rate. A finance joke is that sales grows at this rate, dividends grow at this rate, and management gets fatter at this rate, right? Everything in the company grows at this rate. Finance jokes are not too funny, right? But it might help you remember this thing. So I take the dividend next period, and I say it was $4.19. It's going to grow at 5%. So I multiply it by 1.05, treating that 5% like an interest rate. And we multiplied by 1.05 to grow, make money on our investment if we are making 5% interest. So $4.19 grows theoretically to $4.3995. Then I can go to Gordon's formula. KS, cost of capital on the stocks, is D1, next period of dividend, which is 4.3995, divided by price of the stock at time 0, which is given to us as 50, plus growth rate of 5%, or KS is 13.8. Notice that Gordon gave me a different answer from CAPM. CAPM gave me 14.2, Gordon gave me 13.8. I don't stress too much, this is normal. But if CAPM gives me 14 and Gordon gives me 8, then I look for my errors. Same as you do calculations. If KD is 10%, which we calculated in this case, and it was 10%, cost of debt capital, and risk premium is 4%, premium is given to you here. This is how much the equity of comparable firms in this industry has more cost than their debt. So in real world, we have to look at cost of debt, cost of equity in that particular industry, for example, for 12 airlines, and then average this premium, and we get 4%. Investment bankers know this as one of the tools in their business. But the rest of the job is very easy. The formula says pay cost of debt, which was 10%, and put a premium. So it's more than 10% because it's not debt, it's equity. And in this industry, given the risk of these airlines, 4% premium is justified from the past data. So it becomes 14%. Now we have three different numbers. As I said, the job is an approximate job because cost of equity cannot be precisely calculated. CAPM says 14.2, Gordon says 13.8, debt plus a risk premium says 14. We average these three numbers and we get 14% in this classroom exercise. Let's say the company issues new equity. If you issue new equity, you have to pay those fat investment bankers a cut. And the problem becomes harder. Usually we don't have this problem because established companies like SAP do not issue new equity. In fact, seasoned equity or new equity, it smells bad. I do this funny thing so you remember it. Because it dilutes the ownership of the old stockholders, equity holders. We don't like firms issuing new equity. But if you get a case that they issue new equity, then you simply say, well, if the stock is selling at 50 and the investment banker charges 15% for what he or she raises for you in a seasoned offering, then you don't get 50. You get 15% less. You get 42.50, which is multiplying by $50 by 1 minus 4.15. That's for the 15% that the investment bankers get. So you get 85% of the 50, or you get 42.5. The rest of it is our old formula. Cost of equity from Gordon's formula is D1, which is 4.3995, divided by this 42.50, which is how much of the 50 you get, plus 5% growth rate, and it's 15.4. Okay, we ignore the flotation cost because usually there is no seasoned equity, and I believe that's the case for SAP. But when there is seasoned equity, there is a big deal about it in newspaper, and you would know. Then I got to calculate weighted average cost of capital. So weighted average cost of capital is weight of D, of which they give us. If they don't give us and we are a consultant, we can calculate this either from the accounting books, which is less precise. Essentially, we see how much debt and equity divided into preferred and common equity they have in their balance sheet. And adding this up, you get the total balance sheet. Or we calculate as real world, which is a pain in some, because you and I have to grind our fingers down, fingernails down, right? And sit down and figure out how much debt this company has issuing in the real world, multiplied by the cost of debt. But there are different bonds with different costs. Usually we take this 15-year bond proxy and go with that cost, and go with the amount of debt they have. But we have to estimate all this. But all this thing is done, and of course it's done in real world on a Bloomberg terminal. They give you their capital structure. They simply say the capital structure is 80% equity and 20% debt, and you can read this off from the data that is provided to you. In this problem too, the capital structure is given 30% debt, 10% preferred stock, and 60% common stock. Then it again becomes an easy matter of putting numbers into an equation. 0.3 times 10% times tax rate of 40%. I have to get the real world tax rate for the company for last year. 0.1 times 9% cost of preferred, which we calculated. 0.6 times 14% cost of common stock. And that gives me 11.1% WACC, or weighted average cost of capital. Homework. Real world example for cost of equity capital. Let's do it together. I've done it for the past, and I'm going to do it for SAP. It said KRF, or risk-free cost of equity, not equity, debt, the risk-free rate, use the interest on shortest maturity of government bond. Basically, you got to go on internet and find this thing. Last time I did this was 4 years ago, and in 2002, this thing was actually negative. In Germany, we have negative interest rates, and that is interesting. So it's still good to stick with it. But the site that I found it was worldgovernmentbonds.com, and I have it here for Germany historical data. But you go and find it on internet, and maybe look at a couple of sources, because sometimes this thing is less accurate, or you get it from a Bloomberg terminal, which we have. One of our classmates is working on getting this Bloomberg terminal for us, and hopefully we'll have an appointment to go down there. And we were in a committee together with the professor who is in charge of this Bloomberg terminal, or who kindly got it for us. And I kind of told her that we are looking at it. So they're aware of our interest, right? Your interest, right? They're looking for it. Yield is negative here, 0.698. You look for this yield at a particular date, and you write that date down in your report. And what I looked at was 3-month bonds for Germany, the shortest I could find. Here is another curve. Again, I have the site where I found it. It says marketriskpremia.com. It says how much was the risk premium for DAX, for German stock market. And that is provided via a graph, and you can read the time on it. And the implied risk premium was 7.7%. The risk-free rate was minus 0.62, which I got it now from two sources. Here it says minus 0.62, and here it says minus 0.698. You get some approximation there too. So it's somewhere in between there. And implied market return was 7.08, because risk premiums were negative, so you got less cost once you put it in the CAPM form. Then you want to get beta. Usually we don't calculate beta. Maybe in a PhD dissertation for fun. We usually don't do it in a classroom. It's easy to calculate, actually. You'll get the past data on DAX, how much money they made us for several years, and you get the past data on Siemens. And then you run a regression. And beta is the slope of this regression. If beta is 0, this regression is a flat line with a slope of 0. If beta is positive, which usually is, if it's 1.2, it means the regression goes uphill. And sometimes these slopes are printed or given on the Autobahn for the truck drivers. And if beta is negative, it means we are going downhill. So beta is the slope of regression line, running how much the company have made us over the years, or sometimes we do it daily or monthly, against how much DAX had made us. But we looked this thing up, Bloomberg terminal or some data provider on the internet. I looked looked it up at this site, and this is when I looked it for a company called TeamViewer several years ago. That was our company, not SAP. Then we go to calculating growth rate, which is very important. A given company makes profit. We call it net income. That's at the bottom of the income statement. So to calculate growth rate, you look at the bottom of the income statement. Of course, sadly, sometimes this is a loss. Okay, let's say profit is €1,000,000. Then the company does two things with this profit. Pays it out to equity holders as dividends or retains it. So we want to calculate what is the retention rate, what portion of it is retained. So if the company keeps 40% of the profit and pays 60% of it out as dividend, the retention rate is 0.4 and the payout ratio is 0.6. They always add up to 1. And of course, we know the dividend on one share because they paid it, let's say in March, and we know how many shares they have. So we multiply the dividend per share by number of shares, and then we subtract it from net income, which we see on the income statement, which is on the firm site or on internet or on Bloomberg Terminal. Okay, so we calculate a retention ratio. Another name for this retention ratio is plowback ratio. It comes from farming. We are plowing the seeds back as capital into our operation, expanding the factory. So some of the profit, a percentage of profit is plowed back. And we multiply this by ROE. ROE is return on equity. This is an accounting ratio. This is very easy to calculate, and you and I should calculate it by hand. Return on equity is net income or profit, which comes from the bottom of the income statement, divided by how much equity, common equity the firm has, which comes from balance sheet. In the balance sheet, you have total equity, which is total of two accounts. One is how much equity we got when we started going public. In an initial public offering, we sold our stocks to common stockholders. We became a public company. And the second account is retained earnings, how much profit every period we kept. And these owners became richer and richer. These two add up, and this says the common equity holders, how much they are worth in our balance sheet. The rest of it is liabilities we have to pay to debt holders. So balance sheet is liabilities plus common equity, one side, who has their hands on our assets, and the other side is assets, short-term and long-term assets. Okay, so growth rate is a portion of the profit is kept and used for growth, multiplied by a return that we get normally. So we are assuming this return will stay the same. And this is accounting return. This is not real world marketing value, market value. This is accounting, so it's a little bit more approximate, but gives us a growth rate. So retention ratio or callback ratio is 0.5. This company paid half of its net income as dividend and kept half of it. Return on equity for this company is 10% last year. They made 10% money for their equity holders. Their profit was 10% of the amount of equity they had on the balance sheet. Then G becomes retention rate times ROE, or 0.5 times 0.1, or 5%. Calculate the growth rate from the following balance sheet and income statement. An example. Here is a balance sheet, and I have the asset side, and here I have the liability side. So I go to common stock, which is how much money we raised when we had the common stock, and then we go to retained earnings, and those two added up and become 492. This is an unusual case where common stock had gone up from 460,000 to 1,721,000. That means this company issued seasoned equity, something that companies usually don't do, and it smells bad, right? But this one had done it, and you can see it from the balance sheet. If a company issues seasoned equity, this common stock account goes up. One time we did this CFA challenge, and we had a company that this common stock account had gone down. That's a company that had losses many years, and this retained earning goes to zero, and owners lose more money. They lose some of their initial investment. So that can happen too. Then we go to the income statement, and of course, we read the bottom as net income. So if we want to calculate the return on equity, we say 253 in thousands divided by 1,952,000, and we get a return on equity. And earning per share is also calculated here. And dividend per share is calculated, and number of shares is given, and other data is given. Okay, so return on equity equals net income 253.6 divided by total common equity 1,952,000, which comes to 0.13. We multiply it by 100 and report it as 13%. Earning per share, we can calculate this also by hand. This would be the net income, which is 253.6 divided by number of shares, which is given in this case. Number of shares is given as 250,000. So 250,000 divided by 253,000, or the other way around. Net income of 253 divided by 250,000 shares gives you an earning per share of 1 point something. So makes sense. Dividend per share cannot be calculated. This is decided by board of directors, but it's a data that is given to us, and it's 22 cents for every shareholder in this case. So every shareholder made $1, but we paid them 22 cents. The rest of it we count. So we can calculate payout ratio. Payout ratio is 22 cents or 0.22 divided by 1.014 or earning per share, and it's 22%. The rest of it is retained, or if 22% is payout ratio, 1 minus 22 or 78%, 1 minus 0.22 equal 0.78 or 78% is plowback ratio. Now, if we want to calculate growth rate for this company, the growth rate would be returned on equity, which is 0.13 multiplied by plowback ratio, which is 0.78, and that's 17.16%. So we have a growth rate to put in the Gordon's formula. For a mature company, G is somewhere between 3.6. So here, between 3 up to 6%. Here you have a benchmark to calculate. Benchmark means we do this calculation and we get 14% growth rate. Then we start doubting ourselves. Think of these growth rates for mature companies similar to growth rates for countries of the world. If Germany grows by 2%, we'd be very happy. Germany will not grow by 15%. That's a rate that applies to China or India because they have a lot of places in that country that still has horse and buggy technology, and they can grow and bring those places up. We don't have that. So for industrialized nations of the world, when you look at the growth they had in a given rate, 2%, 3%, something like that, quite good. For same thing applies to the company. These growth rates for IBM, for Microsoft, mature middle-aged companies, it's more like 3 to 6%. A growth rate of 20% is for a startup company. The company in Wiesbaden that makes this vaccines for corona, that sort of company. This is a G which is in line with a high growth business. A few years past IPO, that's the 17.6%. If this is not, if this is SAP and I get 17%, I'll say there is an error somewhere. I go back and recalculate it, right? So you have a benchmark for calculation. Then you get to this wonderful name, CAGR. You get some finance, usually chief financial officer, coming and giving a presentation, and he or she keeps saying CAGR. Does anyone know what a CAGR is? This is really a growth rate, one of those funny words we have in finance, and they do that to show off, right? But today we learned that they can't show off to you and I, right? Here is how you calculate CAGR. CAGR is the ending value divided by a starting value. So ending value was 150, the starting value was 100. So this would be 150 divided by 100, which is 1.5. Raised to power of 1 divided by n. That means if n is 2, that means take a square root of it. But here n is number of years, 1, 2, 3, 4, 5. So divided by 1/5. You put it in a financial calculator or in a scientific calculator, and you get a growth rate. This thing is really geometric growth rate. What does it mean? Let's think of interest rate. If interest rate was 10% and you invested 100, after a year you have 10 euros of interest. You multiply 100 by 1.1 and you get 110. And that would be your principal plus interest. Your 100 becomes 110. So far, very easy. You're back in high school or first finance class. But you put this money in for 2 years. The second year, you start making interest on interest. Your 110 makes 10% interest. You multiply it by 1.1 again. So this becomes 100 multiplied by 1.1 raised to power 2. That's called compounding. And you want to know what interest rate per year or what growth rate per year would have gotten you from this 100 to, let's say, 121 after 2 years. And that's the CAGR. And to calculate it, you say, well, I took the 100 and multiplied by 1.1 raised to power 2. Now I get the ratio of these two things and take a square root of it, because before I raised it to power 2, and I find out that 10% interest rate. It's a calculation device. In finance, we calculate a CAGR for our sales. We say our sales have grown by 5% on average, geometric growth over the last 10 years. CAGR is 5%. We calculate a CAGR for profit. We calculate it for various things. So it's nice to know this CAGR, and also in an Excel you can calculate. And that's the formula for Excel calculation. Let's summarize valuation methods. In this class, we got 3 different methods. We use all 3. corporate value model, firm multiple model, Gordon dividend growth model. Also with Gordon dividend growth model, we could have companies that don't grow. Simply we put G equals 0 in the formula and it works. It becomes really a perpetuity formula if you put G equals 0. And you have constant growth that allows us to use the Gordon's formula. But if we don't have constant growth, the problem becomes more hairy. We have to take it to the barber shop. We'll do that now, right? Deal with a variable growth. Okay, here is an example of a real world calculation that you can do for SAP 2. In this example, they say WACC or weighted cost of capital is 10%. That's something that you and I have to calculate, and it's a rather long calculation that you saw in this class. It took some 45 minutes or so. Once we calculate WACC, we discount every cash flow with WACC, not with interest rate, not with cost of debt, not with cost of equity, but with weighted average cost of capital. That's 10%. Then to value a company with like a cash machine, we say this company makes some revenue, pays different costs, gets to EBITDA. By the time you get to earning before interest and taxes, EBITDA, you have paid the variable cost, workers and suppliers. You have paid the fixed cost, management and overhead, building and everything, and insurance. And you got to EBITDA, earning before interest, taxes, depreciation, and amortization. Then you pay down. You pay depreciation for your machines or patents that have gotten older. Then you get to EBIT. EBIT is this output pie. Pie is a nice American word for cake. So imagine the company has a cake, the wealth we generate. Then various stakeholders come and want a piece of this cake. Like children that want a piece of that pie, right? One of them would be the government, wants taxes. One is the debt holders want interest. So we start paying this thing. EBITDA, now is EBIT. Now earning before interest and taxes, we pay interest. It becomes earning before taxes. Then we pay taxes. And then we get to the bottom and we have net income. This net income is paid or wealth for the owners. But the problem with this net income is depreciation was a non-cash cost. What does a non-cash cost mean? If I purchase this computer for €1,000, that's a cash cost. But this computer can be depreciated. Government gives me a life for it, 4 years. Gives me a depreciation method, a straight line depreciation. I get 1,000 divided by 4. Every year I can deduct 250 depreciation cost for using this laptop in my business. Let's say we are in year 2 of the life of this laptop. I subtract minus 250 as depreciation, telling government the machine got older. But this 250 doesn't drop from the back of the machine. I don't pay 250 out of my pocket. I paid 1,000 2 years ago. But I deduct this cost. So it's a non-cash cost. Because it's non-cash cost, the money is in my pocket. I add this to net income. So net income plus depreciation with cash flow. And these cash flows go into this timeline. So cash flows have to be calculated, and they are profit plus depreciation. sometimes we have some of this money budgeted for investment. So we subtract minus I because that investment also goes to the firm. The rest is free cash flow that we do. So these are cash flows in this case. Given the first 3-year cash flows, a cash flow growth of 6% after 3 years and a WACC of 10%, find the firm's value. So straightforward valuation problem. In this valuation problem, we do a timeline. In finance, we always do a timeline. It makes our job easy. Time zero is today when we are doing the calculation. In this example, after 1 year, we have to pay 5 million to purchase the company. So minus 5, because cash flow goes out of our pocket. After 2 years, the company makes a cash flow of 10 for us, keeping our eye on the cash. Nothing matters. This is like a cash machine. And the finance department says the company would generate 10 million for us. We put it at year 2. At year 3, it's estimated that the company would make us 20 million after paying all the other costs. After that, it becomes hard to forecast this future cash flows. The forecast comes from forecasting an income statement, applying those KGARs, the growth rate, to the past sales, to the past cost, getting a forecasted income statement. But these income statements are trustworthy because the numbers in those are taken as goals by financial analysts. That's what we are practicing today in this class. If those goals are not reached, the stock price dramatically drops. So we hold the management's feet to the fire. This pro forma accounting statement for next year, the year after, these are on internet. These are things that are on Bloomberg, and we can get them. And from those, we estimate these cash flows. We look at the profit, we add the depreciation, we subtract the investment that they want to have for the next period. Investment usually shows looking at fixed assets and see how these fixed assets change. They buy more machines, more factory. And we get cash flows. So cash flows comes to minus 5, 10, and 20. But like forecasting the weather, if you ask them what's the weather today, tomorrow, the day after, they have some reasonable forecast. If you ask people what the forecasted weather is for July 21, 2025, they look at average forecast or average all temperatures for Germany at that date. They're saying we can't forecast that far in ahead. So we're doing the same thing here. We're forecasting pro forma accounting statement for 3 years in this case, getting cash flow estimates for 3 years. But for the year after that, we are using Gordon's formula. The beauty of Gordon's formula is that it can be parked anywhere in the model. Here, we are parking it at year 3. It says the cash flow at year 3, the value of the company sold at year 3, all the future cash flows they will give us, how much is the value that's forecast, equals to next cash. The next cash flow is estimated by year 3's cash flow, which we got from the pro forma accounting statements and we forecasted. But they say they grow at 6%. So grow 20 at a rate of 6%. Multiply 20 by 1.6 and you get 21.2. That goes in upstairs of the formula. This would be dividend of next period or cash flow of the next period. Estimated to be 21.2. Divided by WACC, which is 10%. I also colored the red box here, 10%. Minus 6%. Yellow box, the growth rate. In other words, Gordon says you get 10% cost, weighted average cost of capital, but you get 6% growth that pays this cost. So the difference is 4%. Intuitively, that's what it means. Okay, discounting all this gives us a TV or terminal value for this company. Roughly, we are saying if we sold this company after 3 years, TV sub 3 is worth 530 million euros. So this 530 sits here as a terminal value. We have to use it for SAP too. Now we have 3 cash flows, a terminal value, and we discount all of these, bring them to present. So minus 5 in this case, divided by 1.1 becomes minus 4.545. 5 million cost a year from now is only worth 4.5 million this year because it's discounted by 10%. We can make that much on our capital value. 10 million 2 years from now divided by 1.1 squared becomes 8.2 million. 20 million 3 years from now divided by 1.1 cube becomes 15.026. And 530 million terminal value sitting at time 3, even though the cash flow in upstairs comes from time 4, which sometimes confuses people. That's why the graph is good. 530 must be discounted for 3 years. 530 divided by 1.1 raised to power 3 gives us 398 million. You add these numbers up and you say this project is worth 416.9 million. If we pay 5 million and buy this factory, we can expect a 416 million generation of wealth based on this expected cash flows. So that's one valuation method. And of course, when we are looking at the stock prices, we have to make this per share to value a share of a stock. And then if that value is more than what the stock sells in the market, we give a buy order. If the firm has 40 million in debt and has 10 million shares, what is the firm's intrinsic value per share? This word intrinsic value means that's what they are really worth it, but the stock market price them a little different. That gives us an opportunity to buy or sell this stock and make money. Okay, here is our basic valuation formula. Very easy. Set value V equals value of debt D plus value of equity E. We use it a lot in finance and accounting. In other words, value of equity is total value minus value of debt. Value of the firm to equity to all owners was 416.9 million in this case. I wrote it in dollars. Minus value of the debt, which is tell us it's 40 million debt outstanding. We can get it from the data providers. Gives value of equity. So equity is worth 376.94 million in this case. They have 10 million shares. So divide this by 10 and value per share equal value of equity divided by number of shares. If you like formulas, 376 divided by 10 gives us 37.69. We say a share of a stock for this company is worth roughly 37.69. Now, if the stock is selling at 50, we say it's overpriced, sell it. If the stock is selling at 30, we say it's underpriced, buy it. And if it's selling at 37 or something roughly like that, we say hold. Hold means it's not worth paying that fat broker fee. Don't sell it, don't buy it. Stick with it if you have it. If you don't have it, don't buy it. How do we calculate these future cash flows? Usually companies calculate these pro forma accounting statements and give it to you. Usually it's on their web page, and usually we can trust them. Usually Bloomberg has them. But if we wanted to calculate it, or if we worked for that company and our job was in accounting to calculate this, we use these KGARs, the growth rate. Calculate KGAR from last 5 years income statement for sales. Calculate KGAR for COGS, cost of goods sold, for SG&A, selling, general, and administrative cost, or fixed cost. Multiply current sales by 1 plus KGAR. So we just treat it like an interest rate and increase the current sales to forecast future sales. Use estimates of investment and debt to come up with future DA and ROE. This is R is the investment level, DA is depreciation and amortization. To subtract from EBITDA and come up with earning before taxes, use the tax rate to arrive at net income. This is the naive method. A more intelligent method is to talk to our salespeople and say, well, what will happen to the sales next time? What kind of vibes are you getting from the customers? Are they buying more? Are they buying less? Well, then the salespeople say, well, we had inflation, times look tougher. I think the sales are going down, even though KGAR says it's going up. Then we adjust and go with this more sort of intelligent method. But the first pass is this KGAR from past data, sort of assuming the same growth rate and going to the future. KGAR for sale. That's it. I don't have much numbers there, fortunately. Firm multiple method. I have 15 minutes left, right? This multiple method is quite easy. I talked about it in passing. Let's do it again. I said you are sitting in a meeting and they say how much this elevator company is worth. You ask about their sales and multiply it by a number like 1. And then you say that's the value. So this is also a valuation method that you could also use for our company, SAP. Essentially multiplying their sales yearly by a number that is appropriate for that industry, and that number is usually order of 1 something, and coming up with value. That's another rough method for valuation. There are 3 different ratios that are commonly used by investment bankers or analysts, like what we are competing to be. Analysts often use the following multiples to value stocks: PE, or price earning ratio; PCF, price cash flow ratio; and P sales, price sales ratio. I just used price sales when I talked about the elevator company, and that was something like 1. But you could get these ratios for the industry, and it's usually on Bloomberg, or you can get it from other data providers. Here is an example. Given that average PE ratio for airline industry is 2.0, average PE ratios are given by data providers for every industry. And United Airlines, an American airline, is expected to have $28 earning per share. This is also easy for you and I to calculate. We go to the bottom of their future income statement and get the net income that they forecast. And we divide it by number of shares, and we get a future earning per share. So their expected or future earning per share, which is given today, is $28 per share. What is this expected stock price? Well, the formula says we have a PE ratio that is 2, and that's P, price, divided by, which is earning per share, and earning per share is 28. We put it in the formula and we calculate P. Or in other words, the price should be 2 times 28, or $56. So we calculate roughly a stock price for this company. This PE is very common in finance literature, including the newspapers. For example, at the times that we had this dot-com bubble, when we had these internet companies being valued very highly, we were seeing price earning ratios of about $30. And a lot of us finance the board scratched our head and said we have never seen 30 PE ratios. This industry shouldn't have 30 PE ratios. Others said that this is a unicorn effect. Unicorns, you don't see them, but these companies are so special that their valuation is special. And your old finance method doesn't go. My old hat says about old finance methods, right? As I left home, my wife said, when you have this thing up, you look like an Auslander, and if you have it on your ears, you become an inlander. So it's a multi-purpose hat, right? Anyways, as soon as I left home, I rolled it up, right? All right. They were saying you can't have 30 PE ratio, right? And those of us who were conservative said, well, you can't have it. They said, no, you don't know what you're talking about. These companies are special. Time passed and it was indeed a bubble. And a PE ratio of 30 was very unusual. Basically, the story was that these companies were not having that much profit, that much income, but their valuation was very high. But to be fair to them, for some of these companies, such as Facebook, the valuation was fair. And they found ways to generate the cash flows by advertising other things that those of us who didn't know social media, again, me with my old hat, couldn't figure it. There were unicorns, but they were very few and far in between. And quite a few of these companies got a lot of capital and burned it and went bankrupt. Okay, so this is the multiple method that we use, very easy. Particularly with PE ratio is something you should do for SAP also. Average PE ratio for the industry, and then calculating their PE ratio and calculating their E or earning per share and figuring out the stock price this way too. Firm multiple method. For the price earning model, multiply the earning by a factor such as 2 that your investment banker provides based on experience with firms like yours and your industry. And of course, you get these ratios from Bloomberg terminals too. For the cash flow multiple, multiply current year's cash flow for a factor such as 1.5. Again, these are for brick and mortar businesses, not for unicorns, but those are very few. And SAP is not a unicorn either. It's not Facebook. For the sales multiple model, multiply current year's sales by a factor such as 1.0. Note that the factors get relatively smaller for each multiple. Let's talk about SAP a little bit since we have less than 8 minutes. The company has a couple of controversies that didn't come up during the discussion. Discussion was very much from public relations point of view. Someone who works with investor relations. It was very wordy, lots of words, but not information packed. For some other years, we have been very lucky and we have gotten the chief executive officer. And there was one gentleman that actually visited here at Hochschule Heilbronn 2, the chief executive officer of Brain, and he gave us a lot of information, amazing. But it's a luck of draw. And here we got more information that was from the perspective of relations, public relations or investor relations. The controversies that had happened was one about giving bribes. There was bribes given in South Africa and in Indonesia, and the regulator in the US is charging a huge penalty for that activity. But it's not just limited to SAP. The competition, which is Oracle, it's an American company too, is larger, had the same bribe scandal in India. Essentially, these are large computer systems that you sell to huge companies. And in some countries in the world, unfortunately, India, South America, Indonesia, you don't get a contract unless you give a bribe. So there is that issue, but it had blown out, blown up, blown up. It's hunting the companies that would have some valuation effect too. You want to read more about that and look at that issue. There was some other controversy which is, I would try to put it on internet or give it to you right now. It doesn't come to my mind. But the most important one was this bribery case. Questions, comments for the last 5 minutes of time that we have? Anyone on internet that has questions or comments? Feel free. I believe we can hear you too. No questions? How do you find the task so far? Yes, please. No, not everything. It's an all-you-can-eat buffet, right? I think a good way of doing it is to get a past report and use it like a go-by, something that we have done before. And you want to basically change all the numbers in that past report and make it SAP relevant, use the same format, maybe do this individually so everyone can put their 2 cents in, and then combine it together in a group. Sit down and talk, and someone is good at the math part. This thing actually has all your courses in business. You could do some management stuff, you look at the competition. When you read the report, everything matters in business, and it's in there. It's not all finance. But of course, valuation part is at the heart of it, and that's a finance issue. So if you do this one time yourself based on the time that you have, and then you combine it with others, and then we sort of massage this report. I would look at it, we talk about improving it. It will get there, but you have winning reports from the past. That's where we want to go. And when you go on Bloomberg Terminal, you get a lot of reports. I'm sorry we don't have the Bloomberg Terminal in Tübingen, but you guys can come and visit us at Hospital High Brown, right? We have it here, and I really encourage you guys to make an appointment and go use that, starting with the library. But as I said, a classmate is working on getting us an appointment too. We've done that every year, gone there maybe as a group and learned how to use it. Otherwise, we use data providers from internet. And in Tübingen, we have Thomson Reuters. Usually one professor purchases it, and that can be used at the library too. Other questions, comments? Okay, then thank you for being on internet. Thank you for being in the class. This thing was recorded, so I'll stop the recording, and that's kind of also a notice that it was recorded, but it doesn't